Good evening, everybody. Apologies in advance if you did not get the communication, but if you're live today, there will be no Friday session tomorrow because the market's closed. And I tried to send an email out, but I only sent it out today, and I put a message in the Discord. But if you missed it, we met today, this afternoon, because the market's closed tomorrow. So if you missed it, the recording is out. It's available. Go check it out. Market's closed for Veterans Day. Hey, Michael, good to see you. Got it. Could not meet. Okay, I understand. You know, it's one of those things. I will do better in preparing for market holidays. Obviously, we have more coming up here with Thanksgiving and Christmas. So I will make sure. So bear with me. All right. Welcome out, everyone, to the Market Watch Group Trading Foundations course. We are getting close now. Good news, hopefully, for all you options traders. I had a chat with my partners, and I said, rather than just starting, right, the intent was to start the trading foundations over at the beginning, and then we'll loop it so that at any given time, someone will be within a few months of live interaction for any part of that information, and they'll have the ability to watch the recordings and have access to binge through the entire thing, right? That was the objective. And then somebody, I can't remember who it was, said, well, you know, only 2 days for intro to options in the Trading Foundations course? Only 2 days? And of course, I agree. Only 2 days? That sounds like madness to me. I believe if we're going to do justice, we need at least 8 days. And so, thus was born the Options Foundations class. That's all it has right now is a title. But by the first week of December, it will have a fully formed outline and a slide deck for each presentation. And we will dive into options the way we were meant to, the way the trading gods expect us to. That's what we will do. So I'm excited. I'm like, okay, yeah, let's do it. Options Foundations coming our way. We only have a few more of these. We're going to get into options a little bit. Then we're going to talk a little bit about post-trade analysis. God, that's one of the most underused learning tools in trading. A post-mortem, right? Let's exhume the body and figure out what the hell happened. What did I do right? What's working so I can keep doing it? What did I do wrong? What's ambiguous? Where was there gray area in my decision making? Every single trade, we should be like, let's look at our setup. Was it good? Was it bad? Every part of it. We've standardized our trading process. That's part of this analytics that we're talking about right now. Once we've standardized everything, now we can measure it. Now we can improve it. We can evaluate it and quantify it, right? We have so much more ability. Post-trade assessment is coming our way. And just kind of tying up some loose ends, dotting the I's, crossing the T's, etc. Today, we are talking about analytics, one of my most favorite. And I say that about all of these. I'm like, this is my favorite. Whichever one we're talking about is my favorite. But the analytics, this is a numbers game. That's the long and short of it. If you had a one-on-one session with me at any time in the last 15 years, that was said to you in the first hour that we spoke. That's what I said. I said, look, what we are embarking on here, or what we are attempting to, do differently than you've ever done before. You're here because you want to figure this out. You haven't found it yet until now. Because for us, it's constant pursuit, right? Like everything should improve at all times. at all times. And the only way that happens is if we start off by standardizing everything. That's our trading plan. Then we start measuring and quantifying everything and putting data with the decision making and saying, is this right? If the number says it's positive, then hell yes, it's right. Right? That's the point. That's what we're doing. Analytics, the numbers. This is a numbers game. We are engineering our numbers. We are using scientific methodology, observations, hypotheses, plans, measure, assess, implement, or alter over and over again. Shampoo, rinse, repeat. Which is why we want to be so specific. I don't want there to be when I say, hey, tell me how you do this. They'll be like, oh, I sit down and I kind of look for. Once you've said the word kind of, we're in a bad and dangerous place. Kind of, sort of. No, this is exactly what we do. This is when we do it. It's how long it takes. This is why we do it. This is the implications we're expecting, and this is what we're going to do with those implications. And you can see that's what we have the structure and the organization put into place. Let's dive in. I'm already starting to talk too much. Here's the disclaimers. They were there, I promise, just for a second. Today's agenda. Throw questions, throw comments. This is an important one. It has to be, we have to get this right. We need to understand, first of all, the power of numbers. Numbers don't lie. I can't tell you how many times I would talk to people and they're like, I do this and I do this. And they're like, yeah, I'm big on reward to risk ratio. I'm looking for 3-to-1 and I do that. And then I'm like, great. Thanks for telling me all that. Now get this spreadsheet. I said this last session. If I had 5 minutes with the spreadsheet of yours with 100 trades, I know more about you in 5 minutes than if we had a 3-hour conversation. Because I know, and it's not like they're lying. It's just that there's I get it. I've felt it myself, but like almost a shame, and they don't want to tell the full story. I'm like, look, it's okay. Let's get it on the table. You know, the faster everything is open, the faster we can start fixing it. But they say they do 3-to-1s, and then we look at their trades, and their winners are 80% the size of their losers, right? It's like average win 200, average loss 250. And you're like, that's not 3-to-1. That's not even 1-to-1. And what it does is it just shines a light. We can't hide from that. We can't pretend like it's better than it is. That's what's wrong. That's what has to improve. It has to improve, or we have to stop taking risk until we figure it out. Because when we see our expectancy go negative, you just entered Las Vegas, man. Everything there is a negative expectancy. Yeah, you might catch a little here or there, but overall, the longer you play, the more you lose. We're not gamblers here, right? We don't. The difference between a gambler and a trader is a positive expectancy. Period. That's mine. Just so you know, copyright probably like 2007. That's the difference between a gambler and a trader, is a positive expectancy. We trade because we've established that we have an edge. Now, that edge may not necessarily be that we're right more than we're wrong. That's not necessarily what we mean in edge. The edge may be that my winners are 3 times bigger than my losers, which is then good because I'm only right 35, 40% of the time, right? Or whatever it may be. As long as that combination of number gets us to positive expectancy, now we're in business. That's a business, positive expectancy. And that's what we monitor for constantly. And we monitor the variables that contribute to the positive expectancy so that we can see, are we deviating? If we see deviation, that's when we immediately, not necessarily grind it to a halt, but everything gets just a closer examination, right? Especially market conditions. That's where sometimes it can just kind of sneak up on you, and you're like, man, you know what? I've done it myself, where I've held on to a bullish like hope, a bias that I've wanted, and it didn't come, and you're just like, I should have been more negative here, and I see that, and it just sort of helps you to maintain that objectivity, whatever it may be. That's what we're hoping for here. So we want to understand the categories of analytics. There's no limit. I'm gonna expose you to some initial ones that you can be like, oh, okay, and then from there, find a way to explore your trades to find patterns. It's not always like this a straightforward, right? Sometimes we have to just change our perspective a little bit to be like, okay. So we want to understand the types of analytics, right? So within those categories, what are we standardizing as a measurement? What are our KPIs here, right? If this is a business, these are our key performance indicators. This is what we're measuring. Now that we're measuring, we can start quantifying and assessing. At that point, our agenda to the spreadsheet, Batman, to the spreadsheet. We're going to talk about it. Just look at the spreadsheet. Talk about, let you ask some questions. Let's just kind of, roll up our sleeves and look at it a little bit. Then we're going to just quickly discuss some common mistakes made in analytics and evaluating results. We'll look at best practices. Give you some key takeaways, give you your next steps, go from there. Dive in. Questions at any time. Otherwise, I'm just going to keep rolling, take a little drink here or there. My office mate's in with me. He's a little restless. You may hear him get a little whiny, but he'll get through it. Okay, the power of numbers. What are we doing this for? Let's understand the why. Always. Every routine, every rule, everything we do in trading, the more you understand the why, the better equipped you are to execute at a higher level of correlation to rules and discipline, period. Always, right? If I just said, here's your rules, follow them, versus saying, let's talk about these rules. Let's make sure you get, why are we doing this? What's the reason behind this? Why do you need, and then you're like, oh gosh, yes, that makes sense. Okay. Now it's easier to do the job. What are we doing here? Informed decision-making. Not like, oh, some shiny new indicator was presented to us. No, we are building a delicate ecosystem. And once that ecosystem's in place and you establish, you make some fine-tuning adjustments and you get it right, you don't really just like, hey, well, let's try this now. Nah, we do what we know works. It empowers us with insights from data, not emotion. So what are we doing here? This is one of our mechanisms that ensures the computer is being manned by the professor, right? If the professor makes data-driven decisions, the chimp makes emotional decisions. The chimp panics, the chimp is a frenzy, the chimp is reactive. Let's get that chimp in the cage. Risk mitigation. We get to if you notice in the spreadsheet, it allows you to assess or to establish what is your account size and your risk level for each of the baskets of trades that we evaluate, so that we can do exactly this. We can assess our risks more effectively. We can say, this is what I thought I was doing. This is what I actually got. If I say that my risk per trade is 500 and my average loss is 490, some people are like, great, you're right there. Not me. I'm thinking to myself, wait, my risk management says that worst case scenario, I lose 500 and my average loss is 490. So basically, I'm hitting worst case scenario 98% of the time. What does that tell you about my ability to cut my losses short? Yeah, right. You have to say that clearly demonstrates I am not cutting losses short. I am almost at max loss every time a trade goes wrong. Those are the things that we have to see, that we have to be like, oh my gosh, I got to lose better than that. That's for sure. So it helps us to mitigate risk. Lastly, this is performance optimization. That's when we talk about constant improvement, we are constantly trying to improve the process as demonstrated by improved numbers. When we optimize performance, the very next step, and we'll talk about it, this is in our record keeping, it's an always question. People say, Scott, what's Kelly criterion? If you've looked at the spreadsheet, you've already asked that question. What do you mean Kelly criterion? I'll tell you this, there's a book written about this formula in particular. The title of the book is Fortune's formula. if there was ever a formula, I'm like, hell yes, I want to know about that. Fortune's formula. Kelly criterion is risk optimization. Once we go through and we build this standardized, organized, detailed, rule-based process, and we have numbers, we have data, and we have this positive expectancy, what's the next thing we do? Now we say, how do I make as much money as possible with that number? Most traders who have developed a positive expectancy under risk. They under risk, not because they intentionally under risk, because they didn't realize that mathematically their trading could actually sustain a higher level of risk, right? And then it's like, oh, so what do I have to do to make more money? Take more risk. You don't have to take more trades. You don't have to do anything differently, but just raise your risk level. And the confidence comes from a mathematical formula that says, look, you as long as your performance stays stable. Now that's a big caveat, that if we start to see our expectancy drop, we know that we have to immediately adapt our risk, because now we're taking high risk into a deviating system, right? Mathematical decisions, best possible ones to make. Okay, categories of analysis, cumulatively, right? So I'm like, hey, how have I done this year or this quarter? Just whatever cumulative you establish for that year to date, since I started trading, the last year, the last quarter, the last month, whatever cumulative, where you establish the length of time and then you say here. A category of an analytics would be by time frame, where you say, all right, I'm going to look every month. Now the problem is this: is in June and July, I traded probably 3 or 4 times more than I did in August and September. Traded way more. I have less data now. In hindsight, wasn't a great market, so I'm glad I took less risk, but I'm not going to have as much insight into my data. So we have to be understanding of the fact that as we look at data, we need to see by numbers, by time frame, or it might just be number of trades. That's built in. To some extent, cumulative and by number of trades is built in. By system or strategy, you're going to have to learn how to adapt a spreadsheet. You can take my spreadsheet. There is a column that says what strategy is this, what type of trade is this. If you know what you're doing with a spreadsheet, maybe what I'll do is I'll find some links that I can share that'll kind of show you this. But you can actually filter and say, show me only these trades, and then you could actually run the numbers. So you can say, what's my expectancy for buying a call versus buying a stock? Or what's my expectancy for my bounce trades versus my breakout trades? If you ran a business and you had a candy store, you're not going to just like decide, here's 10 candies, I'm going to just sell them. I'll just always buy them and always sell them, right? What are you going to do? You're going to understand what's the demand for this candy, and what are people willing to pay for it, and how much do I pay? So what's my markup, right? And unless you realize that somebody who comes in and buys candy A that is breaking even and end up buying a lot of candy C that makes a bunch of money, if you see a pattern like that, you'll be like, yeah, I'm going to keep doing it. But for the most part, we don't have that correlation in trading. So if you have a system and you isolate those numbers and you see that system is a negative expectancy, you stop. It's a negative it's a losing proposition. Stop trading it. If you want to stop trading it and then evaluate, like, okay, what would I have to do to make this profitable? And then see if you could implement that, great, do that. But we don't just keep trading into negative expectancies. That's against the rules. So by number of trades, by system, by strategy, any way that you can sort of look at what you've done and aggregate it, right? That's what we're doing, is we're aggregating it to see what's my average win, what's my average loss, what's my ratios, how often am I right or wrong. That's how we quantify every system, every strategy, everything that we do. Using what types of analytics? This is the data, the raw, hard data that I need. Obviously, number of trades. That's just counting how many you have. How many of those are winners? How many are losers? My rule of thumb is 25. Now, it's an interesting thing because I used to teach a boot camp style class. Loved it. Great environment, right? It was like a 3-day class. We were up in a nice hotel, catered lunch. I put some weight on, obviously, during that time, eating catered meals 3 times a day. But we were in this class, right? And there was probably 20, 25 people. And I did it for a few years. So a lot of different people that came through that class. So it was almost like a laboratory, right? It was a laboratory where I could see as I said things, as I made statements, or if I talked about certain ideas or things, you could quickly see someone's behavior. It was like a laboratory for trading psychology. So a lot of what I do comes from the experience there. With our analytics, you can see what we're trying to understand here is the total number of trades and how many I need in order to have a statistical relevance. So back to this class I used to teach, I probably taught 4,000 people over a 4-year period of time, about 4,000 or 5,000 people. So lawyers, doctors, business owners, engineers, firemen, whatever, you name it, they came through. I had a chess player, professional chess player, a grandmaster or whatever it is, chess player. I had a professional blackjack player. I had a statistician, a mathematician. Very interesting. Some of the conversations I would have, I talk about it, and I think I talk about in risk management, a conversation I had with the chess player. But I said, what is the minimum number for statistical relevance in analytics? And interestingly, they both said the same thing, 33. 33. And I'm thinking to myself, 33. Okay, let's go 25. It's close. It's close. Do I recognize that I might not have the strength in okay, but I need data quick. I need real-time data as a trader. So I'm going to say every 25. If you ever want it, you could say, you know what, I'm going to change this up, and I'm going to, break down the spreadsheet and expand it and do 33, 33, 33, 33. And it would give you more. And the reason I say that is because when I'm done with a spreadsheet of 100, I'm done. At that point, I came into that spreadsheet probably most likely from a prior spreadsheet. And that prior spreadsheet had information that I used to carry forward and say, here's what I'm going to try to do. And I should probably put somewhere in the spreadsheet for that to happen, where you take some notes about, like, okay, right. Then you take the new spreadsheet and now you're done with it. And what are you going to do? You're going to analyze. You're going to say, I think I can still do better with this. And you're going to carry that to the next spreadsheet. And so it almost is like every 100 trades gives you an opportunity for an iteration on your trading, slightly different rules, or where you're emphasizing something, or we're like, I need to stop doing this, whatever it is that you're carrying. It's that mindset of, I'm learning from what I did and I'm going to carry it into the next one. Percent winners, percent losers, average dollar win, average dollar loss. Those two give us our reward to risk ratio. I need percent winners, percent losers, and reward to risk ratio to get expectancy and to get Kelly criterion. Right? So in order to get percent winners and percent losers, I need number of trades, number of winners, number of losers. In order to get reward to risk ratio, I need average win and average loss. In order to get expectancy, I need percentages and reward to risk ratio. They all interplay. We want to understand the relationship that they bring mathematically. If you change your system and all of a sudden you go from 50% winners to 60% winners, and you're like, yeah, I'm right more often. but you go from a 1.5 to 1 reward to risk ratio to a 1 to 1 reward to risk ratio. You haven't really made any progress. In fact, I think in that regard, you took a very small step back. I believe your expectancy would be 25% in scenario one, right? If I have 50% winners, 50% losers, 1.5 to 1 reward to risk. So my average win is 1,500, my average loss is 1,000. That's a 25% expectancy. If I have the same system, if I'm 60% winners, 40% losers, with $1,000 win and $1,000 loss, I'm actually only a 20% expectancy. I don't make as much money. So doing that, you were right more often, but your profitability dropped. We need to know that. We need to see that to say, oh, you know what? In this case, it's not about being right. It's about making more money. That's the priority. If we don't have all the data and all the analytics, we don't have the capacity to make that determination. Expectancy, that is looking backwards based on all of the trades in this data set. How much do you expect to make for every dollar put at risk? Not every time you're right, but for every dollar put at risk. That's expectancy. The way that I equate that is if I am a door-to-door salesman, right? And I have to knock on 25 doors to get 5 conversations. And of those 5 conversations, I only make 1 sale. So that's daunting, right? You're like 20% of the time, I don't even have conversations. Or excuse me, 80% of the time, I don't even have conversations. And 80% of the time I have conversations, they slam the door, they say no, they polite, whatever. That's a daunting task or a daunting prospect, right? But what if you got a $100 commission? And you said, you know what? That $100, if I divide that by the 25 doors I have to knock, right? I'm getting $4 every time I knock on a door, positive expectancy, $4. And it tells me that for every conversation I have, I get $20. So, right, what are we doing here? We're looking at the numbers of this prospect to understand how that works. That's how we're trying to understand our trading. It has to be a positive expectancy for us to continue with the task, right? So if our expectancy is negative, what does that tell us? It says stop taking risk. You're losing money when you take risk. That's the best thing we can possibly learn. Great, go back to paper trading, learn some things, figure it out. What happened? Why? You should have data, you should have observations, you should have some trades to dissect. If you went live and you took some losses and you feel like you're like not quite sure what's going on, my recommendation is stop taking risk, figure it out. You should be able to do it very quickly. But this is the data that's going to help you to do that. So looking backwards, expectancy is how much do we expect to make for every dollar you put at risk? Kelly Criterion says, based on what we did previously, if you are to continue that going forward, that's the big premise behind this. So if we optimize our risk and then we find that we're underperforming, you better take a step back because you're going to be taking way too much risk for what's happening. If you optimize and then your performance is similar, great. Or if it's close, then you can dial it in, but be very, very careful optimizing risk without enough data. In that regard, I would say you have to have at least 50 trades of consistent trading before you try to optimize risk levels. Okay, let's pause here for a second. Pop to the spreadsheet. Let me know if you have any questions. I'm just going to show you a couple of things. I'm taking a little too long again, as always, but hopefully this is making sense to you. We've gone through this. This is just the entry. This is logging it, right? This is logging it, but this is where if you enter a different system, eventually you can isolate that system. So if you said, this is a newsletter versus my own trades, or this is system A versus system B, you can isolate those later. trade type. So if you buy calls and sometimes do bull call spreads, and you want to compare, am I better at spreads or better at buying calls? Am I better with bullish trades or better with bearish? I can isolate long versus short. So I can isolate these once I have the data. You have to learn to, like I said, manipulate a spreadsheet. But what we're really trying to understand is here. Everything is automated. Number of trades, number of winners, number of losers, percent winners, percent win. This is automated. Right now it's locked. You can't touch it. All you can do is you can say, I have a $25,000 account and I have 1.5% risk per trade. That says that you are looking to take $375 of risk per trade. Now, as you start logging your trades, what's going to happen is there's this loss to risk ratio. What is that? That's taking your average loss and dividing it by your risk per trade. So if I say I'm willing to lose, I have a $25,000 account and I'm risking 375 and my average loss is 500, that is severely problematic. Not only are you not containing your loss to 375, you're literally 30% higher on average than you should be. That's an immediate adjustment is necessary. If my risk per trade is 365, I'd be like, wow, I am not doing a very good job of shutting down trades when they go wrong. Every time I'm wrong, I'm taking too much loss. Or it might tell me I'm position sizing wrong and I'm taking too big of a trade. And by the time I'm getting out, I'm at max loss. Whatever it is, I need to figure that out. If I'm risking 375 and my average loss is 200, I'm in a great place. I'm only losing around half, a little more than half of what I'm willing. So that means that sometimes I'm hitting 400 and sometimes I'm only losing $100 because I tightened my stop or I closed the trade before it went really bad or whatever it may be. These are numbers that we can directly associate and correlate with specific steps and action taken. And now we can quantify that. So we have our loss to risk ratio. It'll tell us how long we're in winning trades, how long we're in losing trades, and how long we stay in after our first. So if I sell half and then I stay in, and I see that I have a long days in after selling, I might realize that I'm selling too early and I need to try to ride it a little bit longer. This will tell me my percent return. It's also going to give you the date range. It's going to tell you when this set of data started and when this set of data ended. So what you're going to see when you're done with this is you'll see how long does it take me to get 100 trades. You'll see, okay, I started on January 4th, and by the end of this one, it was July 15th. So it took me about 6 weeks. You'll see that same range here. And what's happening is it's giving you 25 trades at a time. After the first 25, it automatically moves to the next 25. And now you can start to look for patterns and comparisons. Are your winners getting bigger? Right? Are your winners getting bigger? Are your losers getting smaller? Do you have an expectation of one or the other? You can't just be like, hey, I sure hope my winners get bigger. Well, why would you think that? What are you doing specifically to make your winners bigger? Or are you focused more on making your losers smaller? Right? We're not trying to be all things all the time. Most of the time, you're going to go in with one specific goal: to try to be right more often, to try to make more when you're right, or to try to lose less when you're wrong. Doing two at a time, that can be hard. Try to do all three. I mean, I don't know. I feel like I guess give it a shot. If you do it, tell us your notes. But this gives us at least the ability to standardize things, right? And to really see what's happening. What are the trends within our trading? This also is going to allow you to isolate, so that when you come in here, if August and September wasn't very good, and this is representative of that. It's going to give you your date range so that you can go to an SPY chart and you can say from this date to this date, what did the market do? Right? What did the market do? And you're like, oh, the market actually. So then let's say it was just July and, or excuse me, let's say it was the second half of July through the end of August, right? So I can come in here to SPY and I can say from the second half of July to the end of August, what did the market do? And I could be like, oh, the market went down. So if I struggled a little bit right away, I'll be like, well, yeah, okay, right? In this period of time, the market was down 5%. So if I realized that I was at break even, I might be like, you know what? I can live with that. I can live with breaking even while the market was down 5%. But I might realize that I lost money because I kept trading bullishly. So I look at this and I say the market was down, and then I go look at my posture, and my posture at this time was still bullish. Bam, problem solved. Why was your posture bullish when this was happening? Right? What was our posture doing? It was diminishing. It was dropping. We were more conservative, right? So these are the things that allow you to look backwards and actually learn from it. If you don't have a process to see what was the market doing at that time, what did I think the market was doing at that time, what kinds of trades did I put on at that time, then what do you think we're going to learn from that? That's just it's just, you just keep throwing darts and hoping that eventually it hits the right thing. Okay. Away from the spreadsheet. I'm going to run out of time. I'm going to take a few of your minutes. Like always, I know we're all used to it by now. Where's my presentation? There it is. Okay, a few common mistakes. Overlooking risk management. So if you neglect to prioritize risk management in your analysis, it leads to disproportionate exposure. It increases the likelihood of significant losses. We just have to make sure that we're always combining what are we willing to lose with what are we losing in order to make sure that we have sustainability. Chasing trends without validation. This helps us see, did we chase a market where we actually didn't have the conditions we thought we did? That's going to really start to force you to make those correlations. Right now, they may still be a little uncertain as you look at market conditions and your posture and then how much you're trading and the risk that you're taking. The last one, oops, wrong thing. Over-reliance on historical performance. Look, whatever that market was may not be what it is. Whatever we did, we know it may not be what we're going to do. We are be water kind of people. We adapt, we measure, we do what is necessary, right? That is our objective, is to do what is necessary according to what the market gives us. What are the best practices? Comprehensive data gathering. You got to have all of it. You can't have just a trade log. We need a trade log that has the ability to put in your thoughts, your even your emotions, right? The journal. We need a market log that shows how we were assessing the market at that time. What did we see about it? So we have to have a thorough amount of data that allows us to make these determinations. We need continuous validation and testing. 25 trades, right? Every 25 trades, we have the ability to validate, to look at our strategies, to test and to see what's going on versus what were our expectations, what's deviating, what's changing, what can we do to maintain control. The last thing is to be diverse in your analytical approaches. Once in a while, you can show me the light in the strangest of places if you look at it right. It's all about perspective. I mean, the Grateful Dead are never wrong, right? So, right? Come on. Employ a variety of look at it left, look at it right, look at it forward, backwards. You never know when you're going to all of a sudden just catch a little trend where you're like, oh my gosh. And it leads to an adjustment, or it leads to an adjustment that leads to an adjustment that gets you to that place. You never know when you find that rabbit hole. So just be open to it, right? That's what we're thinking about is look around, be open to what the data tells us. That's the objective. Key takeaways. as always, I'm going to hammer this home. Data-driven decision-making. We don't use emotion. We use data. We use numbers. We use logic. We use rationale. We use processes and rules and structure and organization. Those are the things that give us analytics that empower us to make better decisions. Risk management as a cornerstone. Every day I wake up, that sign in the Notre Dame football hallway. It says, "Play like a champion today." People hit it as they go by. I want one that says, in my office, it says, "Trade like a champion today." I'm going to hit it as I go through. What does that mean? Trade like a champion today. It means your number one job at any given time, manage risk. Manage risk, manage risk, manage risk. Adaptability through continuous analysis. Got to have it. Thank you, Sandra. I appreciate that. I don't know if you have to bail or what, but strategic diversification. Right. Let's be very analytical in this. So now what? Last thing. What are you going to do? Get that log going. If you don't have it already, the journal, the log, whatever you want to call it, we have it. It's there. I showed it to you. Download it, use it. There's a stock log. There's an option log. Get it going. If it's not already there, get your risk management protocols in place, and then measure them and make sure that you're adhering to them. Number 3, commit to continuous learning. Maintain a log, document strategies and insight. Review and adapt. We want to see what we can do better. We want to see what isn't working so we can get rid of it. See what is working so we can do more of it. We want to have observations that allow us to make unique adjustments and fine tuning. That's our constant pursuit, right? Over and over again. And these, you have the mechanisms you need to attain that. Bam. Look at that. I'm giving you 2 minutes of Q&A. I wrapped up kind of quickly today. What are your questions? Doesn't have to be about today's material, but if you have one about today's, so if you've gotten stuck with your record keeping, there's a video about record keeping. There are spreadsheets about record keeping. Thank you, Sandra. Glad you got a chance to sneak away and watch. Thanks for attending. If you have any questions about your record keeping, now's the time. Otherwise, that should be a constant, right? That aspect of your trading is a constant. As I said before, show me a good record keeper, I'll show you a good trader. Well, okay. Show me a good record keeper who analyzes that data. Record keeping without the analytics is a exercise in futility. We gotta have the data. The data leads to adjustments. It leads to refinement of rules and processes. It's what creates this cycle of our process, right? So, all right. Luther, so glad to have you. Thank you for saying hello. Sometimes I don't see it. I hope you see this foundations class. This is getting to the end. I mean, whatever you've ever thought about, go look at in the emails, you'll see there's a content library, and in there you'll see all of the recordings. If it's technical analysis, if it's risk management, if it's trading psychology, if it's right, there's something. And what we've realized is, and I see it in myself, there are some ways I've gotten complacent with some of the things that I do. And this helps us to make sure that our foundation is strong. We build something good on top of it. Remember, everybody, so I'm glad you're with us. Welcome to the group. No session tomorrow because the market's closed. So if you missed it, we had to push to today. So if you missed it, go check your email. There's a recording. We analyze the end of the market and what we're looking for. But we will have the same Sunday market prep, 11 a.m. Eastern. It's about where it was, to be perfectly fair. The market didn't much, just kind of went sideways. A little bit of buying, little bit of buying, little bit of buying, gave it all back. It looks like it may be the start of the sellers. Now we get to see them. Now it gets to start to open this window that we've been waiting for. I'm excited for it. I think we've got plenty ahead of us. Thank you. Michael put a comment on probably over trading. Love it. If you look at one of the documents in the welcome kit is top 10 trading mistakes, one of which is exactly that, over trading. And just the fact that you put that down is amazing recognition. I mean, that's just, people ask me all the time, how do I know if I'm over trading? My answer is this: if you don't know you're not over trading, you probably are. Right? Like, we have to be pretty specific with, this is why I'm taking the number of trades. And so the fact that you're saying that is already the right step. 100% love it. So I appreciate you sharing that with me, and I hope to contribute to your journey and adaptations. All right. Well, you're probably starting to hear the dog. He wants me to, I don't know. He wants me to take him to play, but it's too cold, so I'm not going to yet. It's good to see everybody. Sunday, like I said, I'll send an email out tomorrow reminding everybody not to pop in, but someone inevitably will, but I will try to make sure. Have a great weekend. I'll see you guys on Sunday. As always, happy trading.